What up traders, what up investors, Ken here from the Dyslexic Investor, and we're going to be looking at and trying to figure out and decipher the potential signs of a breakdown of the market or an uproar or a huge uptick in the market. We're kind of in this really strange parallel between the bear and bull market, potentially going either way. This is normally tied to, again, earnings coming out beginning of this coming week. Again, with the majority of the banks reporting, this is going to be a huge indication of which way things are going to go. Most likely, most companies will not give guidance or things like that, and just kind of be a, lack of a better words, a guessing game of what could happen with a lot of these companies. Most of the times, it's usually a coin flip or a rolling of the dice to see what happens with earnings, because again, depending on what Wall Street wants and what the company reports, it could always just be two different various things, and there could always be that capitulation throughout that market. So let's go ahead and dive into the S&P 500. This is again the futures here. As you know, we've kind of been trading in this box or this trading range the past 3 weeks or so, kind of right below the 32.35 and then right above the 3,000. Let's just call it 3,000. Kind of just trading in the range, bumped down here twice. I would call this potential double bottom, but as you can see here, we're trying to climb up higher here to try to break and close above 32.30 potentially this week, with again the huge catalyst being great earnings from a lot of the banks and other various companies reporting this week. We do have a wonderful, fantastic, I would call a sexy squeeze potentially building up here. We've seen that this last potential sexy squeeze that we had here kind of created this trading range box right about here, if I can draw, right here, and it had a nice momentum of continue going higher, seeing that really light teal blue kind of implying for upward momentum. We're seeing that here with the RSI kind of slightly climbing up to around that 70 or to the 60 to 70 level. Volume oscillators kind of really performing the same momentum we're seeing here. Again, potentially trying to break out of this box here to up higher prices. Again, I think the huge catalyst is going to be here due to the overall pandemic and virus numbers, and that of course earnings as well. So this is a really, if you just looked at this, you would probably think this would be a little bit, you would be skewing and pulling for the bulls to win here. That being said, if you start looking at some other indicators as well, which I want to throw in the VIX or the volatility index, the fear index, the scared overall, if this goes skyrocketing, people run to the hills and sell everything, and they whatever. It just, people go crazy when this thing spikes up drastically, and usually it spikes up drastically with the overall market going down. As you can see here, we're kind of slightly consolidating here. Being within the 30 range has been somewhat of the norm over the past since basically the pandemic. Beginning of May, we've kind of been trading within the 30ish to 32 range. Had a spike up to about basically 40 here at the beginning of June due to a slight sell-off. We can look at the S&P 500 on where that relative was. But that being said, we're also having a squeeze here. So this is the squeeze kind of looks somewhat strange close of last week. But again, indication the volume oscillator is zero, or actually in the negative numbers is slightly. We are also seeing a potential, again, the 5 and 8 exponential moving average are still below the 21, which is all, these are all great signs. The only thing we really need to see this continue going lower is to start breaking below 27 to 28. If we start seeing that, that is normally a sign of potentially lower prices because we're breaking through this level. But again, this thing can literally just change its mind overnight and just go skyrocket. Just being slightly concerned here, this is somewhat of a transition point here. If it can bounce off the $27, $28 level, we could see a huge rally coming through here. Again, completely tied to potentially earnings, anything the president says, or whatever else can happen in the world. I don't. It could the list can go on for infinite on the amount of things that could trigger this to the upside. But we are still, it's been beaten down, and only when things are beaten down, it usually could spike up. Again, a lot of people are holding their breath, a lot of people sitting on their hands to kind of see what happens before they start piling in on some stocks. Unless you're Tesla, you're just piling in hand over fist for that one. And the next one, which I haven't talked about too much, was the P call, or it's also called the put to call ratio. This thing usually, with a smorgasbord of the other indicators we're looking at, could potentially trigger a top or a bottom. And normally, I know this looks super crazy. It's nothing too really to compare to at the bottom, so we're just going to switch to this chart here. You really kind of want to look between the 5 and 8 exponential moving average. So it's basically printing like a 72 to 73, indicating that it could be a potential short-term top, meaning there could be in the next week or so some volatility coming out. Again, that is somewhat kind of signaling to what the VIX is saying, but it's really just side slapping the S&P 500 without that conviction. So let's go back. Let's actually bring this down to a daily side. So it's basically showing 61. So on the put call, it's showing is basically a 61 to a 63, and we've kind of seen a 60 to a 58. So if you remember what happened, the 6-8, we can kind of go to this real fast. So we go to 6-8. We had that potential top that we've had in place, and we came flushing down. This is what, again, the VIX, in particular the put-call ratio, is signaling potentially. This is not always right, without a doubt. Again, this is just an interpretation of what is in front of you, but we literally saw it happen just a couple weeks ago, and it hasn't been this low in quite some time. So we can go back all the way to a monthly chart, and that really, I meant weekly chart, and we're hitting pretty close, like the 72 to 76 that we're talking about. The low here on the 9th was around 70-ish. We're already past that on the weekly side, kind of indicating in the next week or so, a lot of investors and institutions are kind of just sitting on the sidelines. So a lot of people are potentially hedging their bets. That is meaning they're buying some S&P 500 puts. They're buying. They're looking for a potential volatile coming week or weeks ahead. That is going to be that informative on that side. So, not saying that this always is triggered and will potentially just create a huge market sell-off. It's just something for warning signs. So if you want to play a little bit more cautious the way I like to play, I like to have some more dry powder, aka cash, on the sideline to see what happens. Again, we have some huge names coming out this week, absolutely enormous names, especially with the bank section. Really going to be huge, could be a really wet towel damper on the overall market if it decides to not perform very well. And again, it's going to be really tied to a lot of data. So let's go ahead and look at the S&P 500 again to kind of give the overall perspective here. Again, really looking to break out of this box here, potentially again to get above that 323 level, 324 to kind of break out. Again, on the S&P 500, we do have those 2 days of squeeze, indicating that the moving averages are very nicely stacked with the 5, 8, 21, 34, 55 exponential, which I've just added to my charts, and then you have the 8 exponential, or so the 50 simple, and then the 200-day exponential moving average down there. So everything is somewhat nicely stacked, leaning towards the bullish side. Just a potential side notes of the VIX, and then of course the put-call ratio, which could go wrong. So I wanted to give you the scenario where it did kind of bottom out a little bit here. So we did see like a 60, what is that? 66. We had a couple low months here. That was in December, and you saw what happened in December. We literally just ignored those hedges and just literally just continue to grind higher. S&P 500 did have a small sell-off in January, but that really just rebounded, and then of course towards the end of February was bye-bye, and it really just took a huge dump. Again, that being said, just want to give this food for thought. Not want to scare anyone. Just want to be very careful out there and be informed on know where your stocks lies, know where the support and resistance are coming from, and things like that. I greatly appreciate everyone tuning in and watching this video. If you have learned something, please like and subscribe if you haven't already. We are having a live stream tonight at 9:30 Eastern Standard Time. Again, on the channel, we're going to be talking some great stocks, a lot of fun. We always have some great new charts and new trading ideas coming from that. Again, guys, thank you so much for watching. This is Ken from the Dyslexic Investor, and I'll catch you guys on the flip side. Peace.